just been spoiled by measuring their net worth or their wealth in a unit that is just declining by the day.
Ladies and gentlemen, as I used to say, another month has passed, and I'm glad to see there Egon von Greyerz again. Egon, the Dow Jones is close to 51,000. We have talks in Iran back and forth while the sides are insulting each other and shooting at each other. In all those mess, we have to keep a clear head and we look what the charts do say us, and they cannot be bribed. So we have to keep our clear conscience and show the people, this is the main topic today, how they get robbed without noticing. Good to see you again.
Well, good to be with you as usual, and it's amazing how many interesting things we have to talk about, and you know, as the world is going to pots, as we say, you know, the world is going to slowly decline into a quagmire of problems, and it will be a long time before the world gets out of that again. But we're here to give us very firm views and very strong views, and hopefully a number of investors will listen to us, because our words are now as important as ever, or more important than ever, I would say. You know, I've been talking about this for 25 years, and so far it's all happening. It's taking a long time, but if you measure it in gold, you know, gold is up from $300 since we went into 4,500. So, and it's just the beginning, isn't it?
Absolutely. We will not run out of topics, Egon, I'm sure. Let's start with some US topics. We first had, as I just said, the Dow Jones record territory while consumer confidence is crumbling. Let me show the first article and then we will move on to Warsh. But I think any hope put in him will be waste. Let's see the consumer confidence, because the retail market is still very important in the USA. It reads, the Conference Board Consumer Confidence Index dipped 0.7 points to 93 in May, down from an upward revised 93.8 in April. The Present Situation Index, I think this is most important, based on consumers' assessment of current business and labor market conditions, retreated by 3.2 points to 121.3, while the Expectation Index, etc., recovered a little bit. And I move on to Warsh, because that was also a very recent important news. As the financial markets await the policy direction of incoming Fed Chair Kevin Warsh, expectations are building that he may adopt a more dovish stance compared to his predecessor, Powell. However, the recent resurgence in inflation poses a significant challenge to this outlook. Warsh's primary mandate will be to utilize interest rates effectively to manage inflationary pressures, yet he has indicated that the current supply-side inflation is likely temporary and not sufficient grounds for immediate rate cuts. Consumer confidence, Egon, I think the consumer is really broken and the problems are mounting, and Trump, he wanted somebody who is dovish. He cannot afford anything else. So as we said it in the past, there is no way out of this situation, and I would expect personally that they will simply keep the interest where it is. What's your assessment?
Well, that's an interesting question, Jan, for the reason that obviously Trump wanted to choose somebody who took his orders and his instructions. And Trump obviously wants the stock market to go up, and he thinks that by printing more money and having lower interest rates, that will happen, so that he and all his friends and everyone in the government can continue their speculation on all markets that they are doing, from what I'm understanding, in a totally uncontrolled fashion. I wouldn't be surprised if Warsh had to promise to make a rate cut after he comes in. I wouldn't be surprised if that was what Trump demanded. Now, does he dare to be independent and say, sorry, it's not justified? Or is he going to do it just as a gift to Trump or as a payment for being appointed, and then a little bit later he will increase rates? Let's be absolutely clear. Interest rates are in a long-term secular uptrend, and which means that bonds are going to come down dramatically in price. And therefore, a short-term reduction would mean nothing, because it would have to be reversed very quickly. So that's a possibility. It would be totally the wrong move to do, as you said, because of inflation. But of course, the pressure on the US and on individuals and on corporations with higher interest rates and this massive debt that this country has, like most other countries also, but the US is the leader in the quantity of debt too. That pressure is so high that, of course, they want to see lower interest rates. But that does, then it would, of course, you would have a collapsing dollar. So it's a conundrum, and they don't know what to do. But the charts are telling us, and the policies are telling us, and the debt level is telling us, and the deficit is telling us that interest rates are going to go up dramatically in the next few years. And the Fed and the president, who shouldn't be involved, will totally lose control of interest rates in coming months and years.
I absolutely agree, Egon. Let's come to gold. And there is this Potemkin village. I mentioned it at the beginning. The stock market in nominal terms continued to rise. As I discussed recently with Uwe Bergold, I wouldn't bet against the stock market, but there are other possibilities. You just mentioned it. The bond market, that will crumble and gold will increase. But let me show to our audience the big elephant in the room. And there is such a clear chart to see how the people are losing money over time. And we see it here, Egon. I can increase it a little bit, that it's still at record high and continues to rise, while in terms of gold, measured in gold, it had its peak already in the year 2000. And it's obviously reflects that from the year 2000, 2000 on, gold was beating the big stock market. And that's the reflection of that. And Uwe Bergold, with whom I did an interview recently, he is expecting that this will continue down to a massive wave C, which means the outperformance of gold against the broad stock market will even increase. Isn't that a fascinating chart?
Very much so, Jan. And I've been saying for years, of course, that it's a total fallacy to measure your wealth in US dollars or in euros or in pounds or in any other Western currency, for the simple reason that you're measuring your wealth against something that is losing value by the day. So everybody knows, and investors know too, but they tend to ignore it, that the best performing asset in this century is gold, of course, which has outperformed all other major asset classes, including, of course, all the stock markets. But investors are still not interested in gold. Only a very small percentage, as we know, 0.5% of world financial assets are in gold. And they don't understand that the only way to protect yourself from what is coming and the collapse of paper assets, bubble assets, the only way is to hold precious metals, gold, silver, and some hard assets and commodities, but certainly not stock markets or bond markets. But investors are still believing that all they hold is going to grow to heaven and never stop growing. But sadly, they will get the surprise of their lifetime in the next, whether it's the next few months, but certainly in the next few years. I think it will start this year, most probably. And we're going to see some major switches out of soft assets or paper assets into gold. But still not enough, because most people will stick to their paper assets and therefore lose most of their wealth.
Egon, most people always stick to something wrong, and this movement is already ongoing for 26 years and it's now accelerating. It's also noteworthy that while gold has started this movement, there are other commodities in general, and energy, base metals, and agricultural commodities who are lacking, and I think who are also worth investing. There's another interesting graph We see here the GSCI commodity Dow Jones ratio, Egon, and this also looks like it's going to break out. And here below we have the sub-indices. It's energy, industrial metals, and agriculture. Agriculture lagging most of the three here. Those are all breaking out, and as you said, it's now the time of commodities.
Yes, and if you look at gold and silver measured also against stock markets, it's exactly the same. You know, it wasn't long ago that the S&P actually broke the trend on the downside, or that gold broke, more importantly, on the upside against the S&P, and therefore, so gold has just started the long-term uptrend against stock markets in the last few months, and therefore that is just the beginning. You know, my forecast is that stocks are going to lose maybe up to 90% or more, 95 in real terms. That is against gold in the next few years. So that's a massive, massive shift of wealth, and therefore massive loss of wealth for the most investors who are into the stock market rather than anything else. And only the few who hold gold will actually protect their wealth during this decline of all paper assets.
We just saw, Egon, that if you take the MSCI World, then it lost already 75% against gold. And if you add 90% on top, my goodness, what remains? But there's another big argument for precious metals, and we see the prices. We are now in the usual flat summer phase. Maybe it's also manipulation, but I consider this a big opportunity for those who are not invested yet. But as I just said, Egon, there is another big danger, and this is the Petro-Dollar. And I have here some new remarks from Kiyosaki and Ray Dalio. Famous author and investor Robert Kiyosaki has once again warned on the future of the US dollar, this time linking his concerns directly to the tensions involving Iran and the changing structure of global oil trade. In a strongly worded post on X, Kiyosaki warned that the ongoing crisis in the Middle East could trigger something worse than war: the gradual weakening of the US dollar's dominance. And now what Dalio said: the hedge fund billionaire said that if the United States fails to resolve the Hormuz crisis from a position of strength, it could begin eroding global confidence, not only in US power, but also in the dollar itself. The debate over the future of the dollar comes at a time when concerns around US debt are already mounting. Long-term treasury yields have surged in recent months, with the 30-year treasury yield crossing 5%, levels not seen since the period leading up to the 28 financial crisis. And the key word for me here was trust or confidence. The dollar was once backed by gold until 71, and then the dollar just replaced this gold in the hope that it was as good as gold. But of course it's not. The trust, as you always said it, Egon, fades slowly and then suddenly. And I think we see now this awakening with the bond market, with the petrodollar. So as I just said it, carpe diem, use the time of such corrections and position yourself if you haven't done yet.
But Jan, you know, I find it a bit ridiculous that people are talking about the dollar is going to weaken. The dollar has been weakening for the last 50 years or 50, 56, 55 years since 71, when the gold window was closed by Nixon. So we already seen a 99% fall of the dollar and all other currencies since 71. In real terms, we're talking about. In real terms is against gold, obviously, because gold is the only money that has survived in history, and it's nature's money, cannot be manipulated in the same way as paper currencies, and therefore gold measures real purchasing power. So it's not, you know, the dollar has been in a long-term downtrend, as I said, for well over 50 years. So talking about a weak dollar now, and that people who talk about the weak dollar are only talking about the dollar against other currencies. But why measure your wealth or the value of your dollar against other currencies which are also falling more or less at the same rate? So that's totally meaningless. you have to measure it only in real terms, and real terms is gold. And as you showed in that graph also on the stock market, measured in gold terms that we just saw, the stock market is doing very badly in real terms. And people have just been spoiled by measuring their net worth or their wealth in a unit that is just declining by the day. And if they continue that, they will also lose all of their money. Now we're down 99%, as I've said many times, since 71. But we're going to go down the last 1% in the next few years. But that 1% is 100% from now. So the dollar and other currencies will lose another 100 or 99% against real money, gold, in the next few years. I'm absolutely convinced that's going to happen.
I agree, Egon. And there is a graphic that we used in the past, a strong correlation between the US debt and the gold price. And I used AI to update this graphic. Sometimes AI is really useful.
Yeah.
Well, here we have the US state debt and the gold price from 1966 until today or yesterday. And what do we see? While we had overshooting and undervaluations, the gap is still there. That tells me, Egon, that there is no overvaluation of gold, not at all. We see here that the increase in the US state debt is a bit flattening, or it's increasing slower, but with this whole Iran mess and the increasing debt and a lot of state debt coming due and need to be refinanced at higher interest rates, it can only go rampant. And what that means, we saw it in the past, and I think the same is going to happen again.
No, absolutely. You can take US or gold against US debt. You can take it against money supply or measure it against a lot of other indices. And it comes to the same. It is the printing of money by central banks and obviously by banks that also multiply their balance sheet. That is what causes the inflation. That is what causes the stock markets going up. And that's what causes the overvaluation of all paper asset prices. So it's a fallacy, as we said before. It's a fallacy to believe that you're looking at real money here when you value your assets. Stick to gold, value things in gold. I've shown before, and we talked about it, valuing, for example, valuing your wealth in cows rather than in money. And my conclusion was that a cow has cost between half an ounce and 1 ounce in gold terms since, for the last 5,000 years. So a cow has remained within half an ounce to 1 ounce of gold in price. That's an inflation hedge. Sadly, you can't keep it in the safe. You have to freeze it in the freezer, and you couldn't keep it too long there either. But nevertheless, it shows you that some real assets are keeping their value, whilst all paper assets are just a fallacy in the form of valuation, because they're not worth anywhere near the dollar prices that people attribute to them.
Absolutely, Egon. And I have a little side note. We also follow BlackRock and those guys who are managing billions. And there was recently a quote that caused some alarm lights. Uwe Bergholt said the most dangerous place are bonds and cash. And look what the BlackRock CEO wants to do with cash, or with the cash of the people. The CEO of BlackRock, Larry Fink, admits that trillions of dollars being used to build data centers and power grids will come from ordinary people's savings accounts and pension funds, and says it's mandatory. He says America needs trillions in AI infrastructure spending and that people will be forced to invest in it. Can you imagine this? We saw the bubbles in the year 2099, and what happened. I think AI is a similar bubble. Better think twice where you put your money. And as I just said it, Egon, it's really dangerous to have too much money at your account and to have too much cash. Better stick with real money.
Well, BlackRock and Larry Fink, they're part of the establishment. They manage basically most pension funds in America. And of course, what they say will happen. But sadly, AI, as you said, is a bubble. It doesn't mean that AI won't continue as a useful tool, but it is a bubble financially, and it will obviously collapse that bubble. The dilemma with AI also is that it's going to kill a lot of jobs. So, which means that, and as I've been saying, the world population could possibly go down to half. It'll take a long time, and it's not just AI that will do that, but AI will be part of it. But it means that AI is then going to make the world so efficient that a lot of people will be unemployed, which means that there's no consumer purchasing power. So all the people that will be unemployed, they're not going to buy the goods that become a lot cheaper because of AI. So it becomes a vicious circle. And therefore, there's a very dangerous side to AI, which we know. And in the end, people are not going to be needed for most tasks, which means also that the world economy will shrink dramatically, and a few people will benefit from AI, but the masses will not benefit at all. They will be unemployed and have no money to buy anything with. And that's why over time the population will decrease. And that's partly because AI. So it's very dangerous. And of course, people know this, but it's going to happen anyway. They're not prophets of glory. These people like think. They're prophets of a disaster that sadly is going to hit the world. It's going to take time, of course, but we're seeing it already, how AI is actually useful. But as I said, it's only an elite that will benefit from it.
That could lead to a society similar to 1984, but that is a different topic, Egon. Let's wrap up today's session with a chart from the recent In Gold We Trust report, and it shows, but we have to show it again and again to the people, it shows how the money devalues over a pretty short time frame. I can only recommend to check the whole piece, it's really worth. We see here the US dollar and the euro, obviously measured starting at 100 in 2007. If we go back to 2000, as we said it, Egon, it looks even worse. But it lost in this time frame from 2007 until now. We see here the percentages. US dollar 85 and something, euro 87 and something against gold. Incredible. And people are happy to have increasing paper money wealth. They should really be very careful because one day it will hit them hard.
Yes, we're preaching this over and over, Jan, to investors, and we have, I have done it for over 25 years, but still, the power of the speculative stock market is so much more exciting to people than gold. That all the money managers declare, it yields nothing and it's very volatile, etc. Nobody understands that it actually is the only thing that preserves your wealth. And as you showed, if you measure since 2007, or if you measure since 2000, or you measure since 1970, or you measure since 5,000 years ago, it's the same. It's just no paper money has ever survived, and it's going to be the same this time again. And we are, as I've been declaring many times, we are at the end of a monetary era now, and we will see the acceleration phase coming now. It has actually started, as you showed in that graph, down since 2007 already, 85% paper money against gold, and that's going to accelerate. So, and people haven't realized it yet, and sadly, most investors will only realize what's happening to their money once paper markets are down so far that for them it's too late to switch to anything else. So therefore, people will just lose their money without taking any major action because they think they will always be saved by the Fed or by money printing or by US president, whoever can save them. And they will never understand that they're actually now standing on the edge of a precipice, and the drop will be very, very, very unpleasant for them.
I agree, Egon. That was your final statement for today. I thank you, and I hope that we could reach some more people. I wish you a beautiful time in Sweden, in the archipelago, the Stockholm, right? And then hopefully see you next month or in 2 months.
Thank
Auf
you, Jan.
Wiederluke.
Always auf Wiedersehen, and always a pleasure to speak to you. Thanks very much.
Absolutely, Egon. Thank you. Bye bye.